Hello, welcome to Your Business, Your Wealth. My name is Paul Adams, and I'm with Corey Shepard on my third take to start this episode. Corey, how's your day going?
They just don't know what goes on behind the scene. Normally, we don't do a lot of editing. We really don't. I don't lose it and say something inappropriate all that much. Every once in a while it happens. But every once in a while we have a morning where we just take a little while to get
a little short on the caffeine, I suppose.
Yeah.
Well, what I love some of the things we're talking about today, Corey, because we've got another set of articles that are just curious and lead us in a direction that if we're not careful will lead us astray. And some articles that leave out, like the article itself isn't bad, but it gives a sense of how much sort of maybe drive-by financial planning, whether that's in the news of something coming by or your mechanic saying something, and how that can lead us astray. And so I'm pretty excited to be able to dig into that today. I want to remind everybody out there that as you get an insight today, just put it in the comments. Give it a like. Send the episode to somebody if you enjoyed the episode today. If you're just listening to the podcast app, it's easy. Just hit that share button. Send somebody a text. You know, I think just about everybody, myself included, I love it when people send us articles for this podcast, or somebody says, hey, here's a great article or podcast on some topic. So know that your friends, family, people that you care about will love hearing this. As one little example, I was talking to a client yesterday, and Corey, we didn't talk about this before, so you guys can all watch Corey's reaction.
Welcome to my life.
Yep. This is kind of how Corey's day goes. So this guy had started a 401k. You know, he's kind of a solopreneur type guy, good earnings. Started a 401k for he and his wife's companies, and is max contributing to them. But for years, he's been doing a SEP IRA. And because he was like, well, my CPA sort of handles this for me, and he likes that. And my financial planner, he's got some financial planner. This is a person that I worked with many years ago, had a question, wanted to reconnect. I was more than happy to do it. But this other financial planner he's been working with that he met somewhere, nobody has brought up like, oh, maybe you should take all of this IRA money, put it in the 401k, and be able to do a backdoor Roth. And very simply is because two problems. One, they may not have seen it. Backdoor Roth is something that far too many advisors do not take advantage of, or CPAs. And second, the threat of loss for one of them that they wouldn't be managing the money, because the CPA also has some kind of financial advising practice. So it's just really curious when you notice the things that can happen inefficiently if you don't have somebody who has that broad-based mindset that can look at all of the assets and be able to coach you. So for those of you listening who don't or are not working with someone like us, who takes that big holistic look that exposes some of those opportunities, some of which come from just having everything on one chessboard so you can see it move. And the people who are clients of ours know that there are people in your world that have never seen that and could use one of these episodes that would make all the difference in the world to them. I think I'll end my proselytizing there. Good?
Great.
All right. So let's hit our first article. And this one I love because it's actually a pretty well-balanced article and doesn't say anything that I would say is like wholly inaccurate. And it talks about the idea, and this is the general debate of pre-tax, like 401k, versus post-tax, which would be Roth or Roth 401k. And the constant debate, as held up by this article, is it depends on whether or not you think you're going to be in a higher or lower tax bracket, one. And this author actually does a good job, Kate Dorr, does a great job of adding in that if you don't have enough of that statutory income, you can actually do better on taxes, Social Security, and even Medicare premiums. So at least she gets that thorough, which is great.
Right.
What Corey and I want to talk about is how it is that almost all of them miss the biggest difference between pre-tax and post-tax, and that is who you are investing with. Okay. Now we know
and people
that,
are like, well, wait, what do you, right there, someone is saying, who are you investing with? It's just me. It's just my
It's
account.
me and Vanguard.
What do you mean?
Yeah.
It's me and Vanguard. Right.
Yep.
Right.
And that's where they stop. But you have an investing
Not what
partner.
Paul's talking about.
Yep. And that investing partner is the IRS. You see, if you go pre-tax, you one day owe that tax. So if you were in a 35% tax rate and $19,500, which is the employee contribution, if you don't put it into the 401k, you will pay approximately $6,800 more in taxes that year because you didn't put the money in the 401k. But the misnomer is that if you put the $19,500 in the 401k, you did anything to absolve you of the tax liability. You didn't. The only thing that you did is you put $19,500 into an account that grows tax deferred, meaning it doesn't have to be taxed until we take money out. But it has to be taxed one day. So we're just delaying the tax and the calculation of the tax, which may work out in our favor or may not. So that's one.
But
now, go ahead.
You think about it, it is a partnership with the US government. You're saying, all right, Fed, like we're gonna be in this together, and we're hoping that things go well enough for you that you don't have to raise taxes on me, and you can have all the revenue you need. Like that is the kind of partnership that you're in. And it's not that pre-tax is not an abysmal thing to have. Like we just got to think about the balance of different risks we're taking across the portfolio.
Exactly. And be clear that your partner has unilateral decision about what amount they take when you take it out. Now, you can choose when to take it out, at least until age 72, but this is the big one. We got $19,500 in there. About $6,800 of it belongs to the IRS, which leaves us with about $12,700 of our money co-invested in there. Now, that means that now the tax rate could go a little lower, a little higher, and that might give you some marginal gain. But this is the bigger problem. It's not all your money. You effectively put $12,700 in your 401k at a 35% tax rate, and the IRS added the other $6,800. Versus if you did a Roth 401k, how much of the $19,500 is yours? Well, all of it, because we bought out the partner, right? The partner in our income, that $19,500, we just paid the taxes and then put 100% of our money in. Now, what I often think about with this is a little bit like, I remember riding on Southwest Airlines, and the one thing you really avoided was wanting to sit next to the person that looked like they used to be a linebacker for the Browns. And they've let themselves go since then. Like, that's the person you don't want sitting next to you on the plane, mainly because they're going to use up your elbow room. You got to share that little armrest with them. But if you have all the armrest in the case of a Roth, then you're not sharing that contribution. Therefore, you get a full $19,500 into a tax-free account that grows tax deferred. So they're both tax deferred accounts. It's just how much of it do you want to own when you get to the end of the road? And to Corey's point, and one thing, and I'm gonna find Kate and tag her in this because I think this is one of the best written articles. She actually goes out of her way to also mention RMDs. So for a short article on the difference between Roth and 401k, I think she nails it. I think what gets left out, not by just her, but everybody out there in the financial media, is that what your real gain is that $19,500 is yours in the plan. You own it 100%. The IRS lets you have 100% of it when you take it out. Okay? So that, Kate, great job. And we would love you to interview us so you can write one that is extra complete on the idea of how much of it you own. All right, Corey, you ready for the next one?
Can I say...
Yeah.
Can I say one quick thing about her, since folks may be reading? So she talks about Medicare Part B premiums, which the more income you're making when you retire and you're on Medicare, there's a base premium, and if you're making more money, they ask you to pay more Medicare premium into it. So that is a reason people might say, well, that's going to make me pay more, so I don't want to convert money to Roth. Well, the higher you are above the base income, the less that difference really makes. So if you do the math, most folks are saving more taxes by doing even Roth conversions past 65 than they are paying more in premium. So it's just, by itself is not a thing to run from. We got to say, what's the net impact of all of those pieces over the long term? And you're paying a little bit more to save a lot more in taxes in most cases. So talk to your financial advisor. Call us, email us at info@help doing that analysis.
Right on. And it is key that what you do is be able to have it, even if you're doing this stuff on your own, don't even take your own opinion. If you're a DIY person, you're listening to this, great. But put on one side of the ledger, this is the outcome if I do X. And then on the other side of the ledger in an Excel spreadsheet or whatever, just compare straight across and the total outcomes. It will make a difference. And that's what your advisors should be doing also, not just saying you should do a Roth without comparing it. Don't take their opinion, because if you allow them to teach you how they did the analysis, you will walk away knowing more and take that into your future. Corey, speaking of
next
taking
article,
it into the future.
Yeah. Well, it's actually a really good article with a great concept and model for thinking, but it's an example of a headline being so misleading or potentially misleading to us that we have to be so careful. So the headline is, student loan borrowers will get 15 billion of student loan cancellation. Now, this is a new article from January 8th. I've been following student loans really closely. I have a lot of physician clients that have big student loan balances. This is a really important topic.
Well, and
so when I read this, I'm like,
if you have a student loan, if you have a student loan and you saw this headline, you are clicking on it. And it doesn't matter if you have 2,000 or 200,000. You see that headline somewhere, you're clicking.
Right. You're like, what? And so I'm thinking to myself, did I miss something in the midst of all this?
Would you guys believe we lost Corey mid-interview? And as Corey said earlier, we don't do a bunch of retakes. So I'm just going to see if he comes back in here, and we'll bring him back in. Let me bring Corey back in. Hold one, everybody. I'm not even going to have anybody edit this. We're just going to leave it as is. Corey is back, I think. All right, Corey, I didn't even slow down. I just let people know. See, I told you we don't edit, or Corey told you we don't edit, and we're back. I didn't say anything about the article. Great job in solving whatever that tech stagger was.
Yeah, I didn't solve anything. I think our software did something weird. So anyway, I'm thinking I missed something in all my research, and Biden had been talking about writing off 50,000 per person. I didn't know if they were adding that 50,000 together, and it's for sure going to happen. So anyway, we get into the article, and basically what it's saying is that the pause on student loan payments that the federal government has enacted during COVID, and the no interest accruing, and the fact that folks are on public service loan forgiveness plans that need a certain number of payments made over 10 years to qualify for forgiveness, like those are still counting as payments, even though no one's making payments. They're saying like that part of the program is effectively canceling this huge number of, amount of loans for folks, which is true. And it's a wonderful way to think about it. And it's actually a clever way for politicians to make that happen in the future. There's so many things I'm into about this article, but gosh darn it, that headline is going to fry some people, because they're going to think like someone could, now this isn't the way I would do it, but someone could read that headline and basically make a different choice about their student loans because of reading that headline, which is not the responsible way to read the news. But if you're making headlines, you've got to know that people will do that. Like, I just think it's basic journalism. So great points for the context of the article and the model of thinking, to be grateful for what has happened through COVID if we have student loans. But headlines can be so misleading.
Absolutely. Yeah. And it is the reason why you've got to be cautious as you're reading of like what, for instance, setting the mood. They're trying to make you feel a certain way. We've talked about that on the show before, that it's the realization of what does this author want me to think? And then when I look at the facts offered in the article, do I still think the way the author wanted me to think? And that's a good way to think about the trustworthiness of the news source you've got coming.
Right.
Yeah. So good. I love that one. All right, Corey, we've got one last article and then a very funny little screenshot that we're going to close out today with.
This next one is really mind-blowing and exciting.
Yeah, this thing is cool. So this is basically a transcript from a podcast or video that was done, and a little bit of a back and forth between two guys. And I was just kind of bored and reading through and just, well, what are these guys saying about the market and all that? So he goes back and forth about the breadth of the market, etc. But this is what I think is the most fascinating part of this article. And guys, if you guys want any of these, you can link to the show notes right in the description of this video or this podcast, and it's going to take you to our webpage where we link to all of these sources, so you don't have to just Google them all. All right. But one of the most fascinating statistics, if you started at the end of 2019, so you take a 2-year view of the S&P 500, is up about 30%. It feels like more because people remember from the bottom of 2020. So keep that in mind, that the S&P 500 is up 30, but it feels like a lot more because they anchored to the bottom of the COVID pandemic. But there's a huge drawdown the first part of that 2-year period, but the S&P 500 is still up 30%. But if you take
only like 15% a year, right? 15% a year since the end of 2019. Yeah.
Yeah, with the COVID pull down in it.
Right.
If you take out the FANG stocks, Facebook, Apple, Amazon, what's that other N in there? And then the interviewer says Netflix. He says, that's right, Netflix and Google. You know what the return of the S&P 500 or the S&P 495 without those 5 stocks? 0.
And that blew my mind. Like, it was hard for me to believe that could be the case, because aren't growth stocks and large caps in general just doing really well? And by the way, all these corporations rebranding themselves are really messing with our acronyms. It's MANA now, isn't it? Microsoft, Apple, Amazon, Netflix, and Alphabet. It's the MANA stocks.
Oh, man.
Like bread from heaven. Here to solve all of our problems. I think there might be some, when that starts becoming common vernacular, there's going to be all kinds of amazing biblical references to the bad and the good about the manna being laid before us. The memes that Paul is going to send me. Oh my gosh.
Yep. Prepare yourself.
Paul asked me, have you seen this meme? And I'm like, Paul, if you haven't sent it to me, the answer is no, I haven't seen it. I have to remind him. He doesn't even need to ask me.
As a matter of fact, I have a fully automatic meme cannon that I launch, but because I want to make sure that all of our clients are cared for and I don't overly offend anybody, I have a group of like 4 people, of which Corey is one, that gets hammered with all the memes that would otherwise get posted to social media. So for that, Corey, you're welcome. Now,
it's like Creed thoughts for Paul. Yeah,
that's right.
That's how it.
For those of you that don't know what Creed thoughts is, there's this really weird guy. Yeah, Creed. Yeah, better yet, Google Creed thoughts. I promise it's not like a horrible thing to Google, like Corey Shepard's.
I don't think so.
Corey Shepard's toes in flip flops. Don't Google that.
Maybe don't do it with your 5-year-old, but with your teenager, you could. I actually don't know, but it's somewhere around PG to PG-13 at most, I think.
So to Corey's point was like, that doesn't seem believable, and so
or like it's like, really? Could it like maybe believable, but for sure? So
I pulled up another data-driven thing that just looked at 2020, and what they did was slightly different. They just peeled out the top 10 weighted stocks in the S&P 500 just for 2020. You could see the performance of those top 10 did like 30% in a year. But
there's a chart further down that shows that of the top 10, that second 5 is only like 8% of the total weight, and it's like 22% of the total weight for the top 5. That's the other thing to remember about the S&P. It's a cap weighted index based, the bigger the company, the more of it is there inside of the index. So the top 5 are something like 22% of the total weighting of the index to begin with.
Yeah, and a lot of people have heard of it as MAGA F, Microsoft, Apple, Google, Amazon, and Facebook as those top 5.
Right.
But it depends on your political persuasion. It's either MAGA F or F MAGA. It's up to you. It's the same 5 stocks. So, but you can see that in 2020, the remaining 490 stocks in this analysis lost money, while those top ones were up a little under 30%. It is shocking, but it's something that Corey and I have talked about. You guys can go back and listen to one of our past episodes where we had this idea that the S&P 500 may be the biggest tech fund you never knew you owned.
Right.
And not to mention that of those top stocks in the S&P 500, the MAGA F, they make up 22% of the S&P 500 in weighting, meaning if you had $100,000 in the S&P 500, you've got $22,000 in that. Now that's in and of itself isn't scary.
Yeah.
The scary part is the other 495 stocks have to split the other 78%, or in this case, 78,000. So it's a big, highly concentrated portfolio if you just own the S&P 500.
2 things jump out at me. One is the power of diversification. And we talk about if you're creating a diversified portfolio, the winners win by so much more than the losers lose, that you don't have to try to sort out the winners from the losers to have some pretty good returns. Now, this is not as diversified as it could be. And so this is what came to my head. Would anyone have put a bunch of their money in just 5 stocks, no matter what they were? Like if you just said, oh, these 5 stocks are going to do gangbusters this year, let's put all of our money in here, no one would have done it. Well, not no one, but most of our clients, most folks that are trying to do something reasonable for the long term. But to say, put a bunch of your money in the S&P 500, a lot of folks are like, yeah, let me jump on that index because it's diversified. Well, it's not as much as you think.
Indeed. It's one of the reasons why one of the checks we do when we do an analysis of somebody's existing portfolio is we're looking at the concentration of the top 25 stocks. And we see some high levels of concentration, higher than what we're seeing the S&P 500 in their top holdings, which is why we try to keep those top 25 holdings under 14% of the entire portfolio. So we don't end up with these accidental weightings. And now what you may not realize, you've looked at your 401k, you selected the funds based upon past performance, but the reason they had similar past performance, they probably had similar investments. And many fund managers and the funds that are getting highlighted in 401ks are these growth-oriented funds. So you might think, oh, I got 4 funds in my 401k, but you may not realize they're all growth-oriented. They're all copying the S&P 500, and you might have that same or worse weighting due to something called manager or fund overlap. So now our fun one today, Corey, to close us out. Now, Corey, this, I just wanted, before I bring this up, not photoshopped, nothing like that. This is something that literally came up on your phone like this.
Screenshot straight from my phone. I was looking up the price of Boeing on Apple stock because we have a lot of clients in the Seattle area, folks that have or have worked for Boeing. It's a stock a lot of people in the Seattle area pay a lot of attention to. And I was just curious. And then I scroll down and see back to back. I thought it was a mistake at first, some kind of glitch. But literally in 2 successive days, like Boeing stock underperforms the market. Then the next day, Boeing stock outperforms the market. I'm like, great. Like, who cares?
On a one-day basis.
On a one-day basis. Yeah.
I mean, that speaks to a little bit of our, many years ago, they said, the attention span of a goldfish. And we're shorter than that now or something like that. Well, this speaks to it so well because they don't even expect you to stumble across what they said the day before.
Yeah. And of course, the phrase "the market" in a headline is one of the most useless two words that you can ever see in writing, because like what is the market? What do they mean? They mean every other stock out there in the world all rolled into one? Do they mean the S&P 500? Like there shouldn't be a correlation, frankly, between an individual aeronautics company and the sum total of everything else. Like, it's very different baskets. Like it doesn't matter.
If they did move in lockstep, you should worry.
You would, right?
That I think that is a great place for us to wrap today. So all of you, as you're out there and you're reading, your friends are reading and people are sending you articles and all of that, is this idea that you just got to read beyond the headline, look at the facts they're offering you, and then begin to construct how you might think about it. Maybe even before you go and talk to your whoever your financial coach is, your advisor, because it's going to give you the best ability to have already thought through and sort of separated yourself from some of the opinion or hype of a particular article or stock, and be better able to receive the input. And I'll give it as Corey and I used to talk about this, and I think this applies to us individually. So at one point, way in the past, we would have people come into our offices who worked for us and say things like, "Oh, I got this great big problem." And you'd be like, "Oh, it's easy. Here's the answer." And what they would do is like represent the problem again and again as you're telling them the original solution, which is the one thing that'll work. And it's almost like they get vested in the problem or vested in their opinion about the problem. So we made a change to say that you couldn't bring a problem to us unless you thought of one solution. And I'm like, I'm fine if the solution is dump gasoline all over your desk and put a match to it. It's fine. You could have the most outlandish solution. I'm going to hire an assassin to XYZ. That's great. You have to thought of one solution, because what it does is it takes us from one gear. Like if you're shifting a car and you want to go from forward to reverse, you have to land in neutral first. And that is what we sometimes don't do. We come so wound up, all emboldened in our way of thinking. And because we didn't pause long enough to start crafting a solution or making a comparison, you might go in and talk to your advisor and actually just have what they give you offend your sensibilities rather than deepen your thinking about it. Because they might just, if you're coming to them with an opinion, they might offer you an opinion in reverse, and you guys go back and forth on that. But if you've already done some grounding and thought it through, you've got a solid chance of being able to receive that feedback. So, Corey, anything you want to add for today?
No, I actually thought we were done, and then we're like, oh wait, we're still. Oh, there's a.
There was 2 more minutes of a bit of a mental burp I needed to share with the audience that I thought could be helpful. So, all right, everybody, we hope that you guys have a great week. We'll see you here next week, and I hope that this has been a contribution to you being able to design and build a good life.